All right. Well, I've got 11 o'clock here, folks, for those of you in Central Time and or noon Eastern Time. Time to get things started here. Good morning or good afternoon, I guess, depending on what part of the country you're in there. Welcome to today's session with Allstate. And we got John Johnson here with us. My name is Tony Frazee. I'm the benefits specialist here with Art Jeter and Company. Again, want to say thank you, everybody who's involved with us here today. Very excited to have Allstate's John Johnson joining us for what I'm sure will be a great session here. Just going to mention here before we get rolling here and turn it over to John, just a quick reminder, we want to make sure and answer any and all questions you may have. So feel free to type those in the chat box or question box. We'll make sure we get those answered before we end today's presentation. With that, John, I'm going to go ahead and turn this over to you, sir.
Tony, thank you very much. I appreciate it. And thank you for the opportunity to visit with you and your producers out there. I'm excited to talk a bit about and let folks know what Allstate Benefits is doing in the long-term care area. We're going to touch on quickly some other elements of Allstate Benefits, and then we'll focus mainly on our whole life and long-term care solution that's becoming more and more popular. So with that, I'll get moving. And Tony, if there's anything that I need to address during this, please interrupt me and let me know. Let's see if I can get my PowerPoint to work. And as Tony mentioned, if you have questions, you can type those in the chat session, in the chat area, and we will address those before we end the call today. So first, I want to give you a bit of background on Allstate Benefits and what we're doing specifically in the voluntary benefits arena. And Allstate Benefits is part of the Allstate Corporation, although we are a completely separate entity from the protection side. The homeowners and auto were part of the same company. You'll notice in the fine print down below, and if you ever do any business with us on the Allstate Benefits side, our insuring company is still American Heritage Life Insurance Company, which is a wholly owned subsidiary of the Allstate Corporation. Our marketing name is Allstate Benefits. We are licensed in 49 states, plus the District of Columbia, Guam, Puerto Rico, the U.S. Virgin Islands, and we do actually have operations in Canada. The lone state where we do not have operations is in the state of New York. So, but we still are able to cover employees that reside in the state of New York. Our plans, as you'll see, are group policies. So if you have a group, for example, that might be situs located in the state of Ohio, but they have employees, some employees that reside in New York, they are able to participate in the plans and they are covered by the Ohio contract. So with that, our products on the Allstate Benefits side are employer-sponsored group plans. So these are group plans. They are plans that are designed to be voluntary for the employees and paid for through employee payroll deduction. So they're designed to be employee paid. They are voluntary. All of our benefits are paid directly to employees. So unlike a major medical plan where they pay the provider, all of our benefits, including on the life side, are paid directly to the employees or their beneficiaries. 99% of everything we do is on a guaranteed issue basis. And you'll see we can even accommodate groups as small as 3 and provide coverage on a guaranteed issue basis. Typically, there are no age limitations for our products. I'll also point out as we get through into the group whole life side, on the whole life side, we do have a maximum policy issue age of age 80. The other plans we can issue as long as they're actively working 20 hours a week or more. Most of these plans do qualify for pre-tax payroll deductions under Section 125, with the exception of the permanent life plans, the whole life plan. And again, because these are group products, the company headquarters determines the site estate and the plan design and the contracts that we use for all employees, even if they're across state lines. Our core products at Allstate Benefits are accident, cancer, critical illness, disability, hospital indemnity, and life insurance. And again, today we're going to focus on the life insurance. We love small groups. We're a unique voluntary benefit carrier in the fact that our book of business is just about equally divided between small group, mid-market, so that 250 to 1,000 life would be mid-market, and then large group 1,000 plus. So we are just about equally divided among all three of those group sizes. We love the small group segment. There are a lot more small groups than there are large groups, and we want to be the industry leader in that segment. We offer very competitive underwriting for the small groups. Again, for groups as small as 3, we can still provide benefits on a guaranteed issue basis. And one thing that I also want to point out, we are a very technology savvy company. The vast majority of the business that we received today in over the past couple of years comes to us from online enrollment platforms. We still do accept paper enrollments. I believe we always will, but we prefer to get plans, policies, new applications submitted to us from electronic platforms. In the small group area, most of our plans are pre-built and available on Employee Navigator, on the Ease platform, and on Easy App Online. Easy App Online has become a great partner of ours. It's a very basic but very easy to use enrollment platform. It can be used in a face-to-face agent-assisted enrollment, and it can also be used for a true self-service online enrollment. And it's mobile compatible, so employees can access the site from their tablet, from their smartphone, and enroll on that. And with Easy Apps Online, it can also enroll core medical, the ancillary lines of coverage. As long as there's at least one line of Allstate benefit plans on the platform, we will pay the cost of the platform. So I just wanted to make sure everybody was aware of that. Okay, now I'm going to switch gears here and go over to a different presentation. Tony, can you see my screen change to the whole life?
I can, sir, yes.
Okay, I love it when technology works. So we're going to spend the majority of our time talking about our Group Whole Life Complete product. That is probably our fastest growing product line. The interest level has increased dramatically over the past 2 years, and it's a unique product to the market. I'm a child of the insurance industry. My father was a Transamerica Life general agent, so growing up, life insurance and insurance in general was a big part of our household. We always knew it was a good week when our dad had to leave the house after dinner to go to a meeting, because back in the 60s, back in the 70s, most life insurance was still sold across the kitchen table. So it was always a good week around the Johnson house if Dad had to leave 2 or 3 nights after work to go out and see clients, because that meant he was busy. Now, today we know that just doesn't happen any longer. The career life agents now are focused primarily on the high net worth individuals, and the average American doesn't get an opportunity to be told or learn about or offered a life insurance product. A lot more of that today is done in the workplace, and we have a very good solution for that. So our Whole Life Complete is a whole life product. And one of the things that I really like about this solution is that we can take a premium dollar and make it accomplish 3 different tasks. It can, of course, provide a death benefit. in the event that the insured passes away, so that dollar can provide a death benefit for their family. It can provide a living benefit, a long-term care benefit, if that covered individual has to receive long-term care. And whether that's community care in a facility or home care, we can now make that premium dollar come to bear and provide benefits for them without the need of dying. And the third thing that does, if neither of those needs has come around in that policyholder decides they no longer need that coverage, it has a cash value. So they can cash that policy out either totally or partially and access the death benefit, access the cash value of that policy. So with one premium dollar, we're able to do three things. You can't accomplish that with the term life product. As soon as they stop paying the premium, the coverage goes away. If they buy a long-term care policy, but they never have to use it, there's no cash value in that policy. If they die before they need to use that long-term care policy, there's no death benefit. So for the average American, this is a great solution. And as you can see, we have multiple different rider options available, and we're going to cover those. I'm going to take one step back. So at the very top here, you'll see that we have an accelerated death benefit for chronic illness. We do not have our long-term care riders improved in every state. California is an example. So in the state of California, and still today, if we wanted a policy effective today in the state of Minnesota, we only have an accelerated death benefit for chronic illness. The trigger for that benefit is still the same. It's a chronic illness. One of the triggers for that, one of the definitions, is the inability to perform two activities of daily living. The difference with this benefit is the benefit amount is set at either 50% or 100% of the death benefit. So for example, if that employee had a $100,000 policy and they become chronically ill, they have inability to perform two ADLs, and they have the 100% chronic illness benefit on there, we would pay that accelerated death benefit out in either a lump sum or in equal monthly installments over the course of 12 months. So it mimics the long-term care, but it is not a long-term care benefit. That's important. If anyone is aware of the Washington Trust Act, in 2021, the state of Washington passed legislation that requires employees to have long-term care coverage. And one of the, if they did not have long-term care coverage, that was provided by the state and it was paid for by a new payroll tax. Employees could opt out of that payroll tax if they showed evidence that they had privately owned long-term care. Our long-term care rider qualified as private LTC coverage and allowed them to opt out. The state of Minnesota is currently, very quickly it appears, pushing legislation forward that will do the same thing in the state of Minnesota. In Washington and in Minnesota, this chronic illness rider would not qualify, it would not exempt them from that payroll tax. The long-term care riders would. So in the state of Minnesota, just for general information, we have filed and these are now all approved and we can start issuing long-term care coverage in the state of Minnesota effective July 1. So I'm going to move on and talk about the 4 different versions of our long-term care rider. Tony, any questions so far?
Not so far, John.
Okay, very good. I actually just wanted to be able to get a pause and have a drink of water. So thank you. Okay, so we do have 4, and actually as I'll show you in the next slide, 8 different options for our long-term care coverage on this policy. These are all accelerated death benefit riders for long-term care. The trigger for benefits is a diagnosis of chronic illness. Included in that is the inability to perform 2 activities of daily living. So on our basic accelerated death benefit for long-term care, once we have determined that that person qualifies for the benefit because of the inability to perform 2 ADLs, after a 90-day waiting period, we begin paying out a monthly benefit that is equal to 4% of the death benefit. So I'm going to keep math simple. If they have a $100,000 policy, that means we would begin to pay out $4,000 per month. That is an accelerated death benefit. So after 25 months, we will have prepaid 100% that death benefit, and the policy would be exhausted and would terminate. Option number 2 is an accelerated death benefit for long-term care with a restoration of benefits. The difference in this is it functions the same way as the basic. You would pay 4%. If that person is still alive and still receiving care after 25 months, the long-term care benefit has been exhausted, but we then restore that original death benefit of $100,000. So there's no longer any long-term care coverage, but their death benefit has been restored. If they were to start receiving the long-term care and then at some point prior to 100% of that being paid out as long-term care, they pass away. So let's say they pass away after 10 months of receiving benefits. We've paid out $40,000 of the long-term care benefit. They pass away. We go back, we restore the original $100,000 death benefit, and they receive the $100,000 on top of $40,000 of long-term care that we paid out. Option number 3 is a long-term care with extension of benefits. This differs from the basic that after 25 months of the long-term care benefit being paid, so we've paid out 25 months of $4,000 per month, so the full $100,000, and they're still living, they're still receiving care. We would then extend the long-term care for another 25 months. So the net impact is that $100,000 policy would end up paying out $200,000 of long-term care coverage and provide coverage for 50 months, which is key because the statistics that I've always seen is the average duration in long-term care is about 36 months. So that would cover the average duration, average stay in long-term care with some additional room on the backside because it would go for 50 months. Our newest version, and this one is also, it's available in Iowa, it's available in Nebraska, it's available in Minnesota once we're able to issue up there in July. The long-term care with restoration and extension is a combination of number 2 and number 3. So that $100,000 policy could pay out up to $200,000 of long-term care. At any point in that timeline, the individual passes away, we go back and we restore the original $100,000 death benefit and pay the death claim. If after 50 months they're still alive, the long-term care benefit has been exhausted, but we then go back and restore the death benefit so they would still have that $100,000 death benefit available to them. So again, that policy would then, on a $100,000 policy, would pay out up to $300,000 of benefit. Surprisingly, the premium difference between the extension of benefits or the restoration of benefits, the premium difference is not terribly different. Surprisingly, it's surprising to me that the difference is not that large. I always say at Allstate, we do a great job of offering so many variations and so much flexibility in our plan design that oftentimes we create confusion because we have too many options out there. I think we're borderline accomplishing that goal here. In most states, not all, but in most states, they have approved two different payment options, a 4% monthly option or 6% monthly option. So that $100,000 policy, we could pay out $4,000 per month or $6,000 per month. The key difference to be aware of is with the basic, it goes from a 25-month timeline to a 17-month timeline. On the plans with extension of benefits, we go from 50 months of coverage to 34 months of coverage. That's how long it would take to exhaust that benefit. Now, one thing I also want to point out, the 4% and the 6%, we will not pay benefits. Technically, we will not pay benefits for a person receiving home care that's provided only by a family member. But we do pay benefits for home care as long as it's through a licensed provider and there's a charge being made. So we will pay this benefit out, the long-term care benefit. We'll pay it out whether it's in community care, in a facility, or home care. When it's home care, there has to be, we're very, I think, extremely lenient on this. As long as there are 2 visits each month by a qualified provider, we will pay out the 4% or the 6%. If there is less than 2, if there's only 1, we pay this out at half this rate. And to me, that's key because this now gives your clients the ability to stay at home, receive care at home, while we cannot pay for them to have care provided by a family member. If they have a licensed provider come in once per month, we will pay out half of this option and extends this to 50 months or it extends this to 34 months. If they have a licensed provider come into their home twice per month, we will pay out the full 4 or 6%. And obviously 2 visits per month are not going to cost $4,000 or $6,000, but we will pay that benefit out. They can then use those funds how they choose. So that's a way that if they are receiving 2 home care visits each month and they're receiving a $4,000 option and the fee from their provider is $1,500 out of that $4,000, they now have $2,500 to use how they see fit, either paying monthly bills, paying one of their children, paying a sibling who's coming in to help them. So it gives them that option. So we do give people a great deal of flexibility whether they want to receive care in a facility or home care, and how they go about that and how they can make this benefit last as long as possible. Our underwriting, we have very flexible, very competitive underwriting. We typically do everything on a guaranteed issue basis. For your groups that have between 3 and 99 employees, we can offer a $50,000 guaranteed issue policy for the employees. We need, if the whole life is the only line of coverage from Allstate that you are offering, we need 6 enrollments to issue coverage. So if it's a group of 6 employees, they can all get a $50,000 policy, guaranteed issue. They would all have to participate. If it's a group of 3 that wants the coverage, you would have to add another line of coverage, like a critical illness, the critical illness plan, or the accident plan, or disability. And then as long as we had all 3 people participate in both plans, we can issue that on a guaranteed issue basis. In groups, excuse me, in groups of 100 to 249 employees, our guaranteed issue amount for the employees jumps up to $75,000. And there we need 10 policies. So if again, you're only offering whole life and it was a group of 200 employees, we have $75,000 of guaranteed issue. We need 10 whole life policies to issue the coverage. If you are also offering our group critical illness, as long as we had 5 critical illness and 5 whole life, we will issue the coverage. The policies stay in force through age 120, 121. If they're still alive, we pay the death benefit. Premiums are payable to age 95, and then the policy is paid in full. Again, we're very technology savvy. We've designed this plan to easily fit on most enrollment platforms, and we can issue rates in such a way that make it easier on the platform system and the person who's building that up. All of our plans are issue age rated, which means that the premium is based upon the coverage amount and at the time, at that person's age at the time that they enroll. So if it's a 45-year-old and they enroll, or a 25-year-old, when they enroll and have coverage, their premium is guaranteed. The premium is guaranteed. The death benefit is guaranteed. The cash value that was projected at the time of enrollment is guaranteed. So there's no interest rate impact. There's no cost of insurance variations that are going to occur. Everything is guaranteed. And I point that out because you'll see down here that we have the ability to issue on an age-specific or an age-banded basis. And I focus on this because when you, for those of you that are in the group medical arena and you're providing employer-paid group term life, when you see age-banded, we all know that typically the rates for that 25-year-old employee are going to go up when they hit 30 and 35 and 40 and so on, usually in 5-year increments. Those rates are going to go up. Here, we still guarantee the premiums at the age of policy issue, but to make it easier for the case builder on the platform, we can provide rates that are in 5-year increments. So for example, the rate for a 20-year-old, 21, 22, 23, and 24-year-old are all going to be the same. So really what happens is we average the rates. So that 20-year-old is going to pay a little higher rate in the age banded than if we were issuing on a age-specific basis. That 24-year-old, their rate's going to be a little bit lower than if they bought and it was age rated specifically. Because we average those rates. That way the case builder doesn't need to build in a unique premium rate for every single age group. And we also, because of that, we offer rates that are tobacco distinct or unit tobacco. Again, if they're unit tobacco, the non-smokers, non-tobacco users get a slightly higher rate, the tobacco users get a slightly lower rate, but we've just cut in half the number of premiums that case builder, for example, if they're using Benefits Connect, we've just cut in half the number of rates they need to build into their system. So we've made it very, very friendly for enrollment platforms. Again, as I mentioned, the premiums are guaranteed level, the death benefits guaranteed, the cash values guaranteed. The policy is portable. So when that employee leaves the group, all they need to do is move that policy from payroll deduct to bank draft. The premium stays the same, the coverage stays the same. They can keep it as long as they want. For people that leave the employer and don't ever notify you or notify us that they've left and want to either cash it out or continue it, if the premiums just stop, the policy converts into an extended term policy. So their death benefit remains the same. The premium, the cost of that death benefit is deducted from the cash value, and it will stay in place until the cash value is exhausted. But the key point is the death benefit remains the same. We can issue coverage on the employees. We can issue a separate certificate on their spouse, also at a guaranteed issue level basis, but at a lower level. And we can offer child coverage either on a unique certificate or as a child term right. Again, the coverage is portable. Issue age on this plan is up to age 80. Guaranteed issue coverage is available up to age 70. So those employees that are 65, 68, 69, and they're still working, they have guaranteed issue as well. And again, the policy endows at age 121. And really, Tony, that is all of my segment of this. So I guess at this point, we can open it up to questions, and hopefully I'll have the answers.
All right. Well, thanks again there, John. Just want to open up the floor, as John said, here for questions. And again, thank you everybody who showed up here today. If you have any questions, anything you want to know about what we've been discussing here, certainly let us know. Go ahead and put those in the chat box or the question box, and we'll make sure and do our best to answer those. Meantime, there then too, looking ahead, if anybody has any other questions, I think of anything else later on, maybe needs a copy of today's presentation, or wants more of a one-on-one consultations, feel free to give me a call here, 800-228-0008, or you at health@jetter.com. Again, anybody has any questions here, feel free to type those in. We'll give it a few moments here while we wait for that.
Tony, I'll fill in the silence and the lack of chat questions with some other basic information for spouses. The guaranteed issue level for spouses in those groups of 3 to 99. Working spouses, we have a GI amount up to $20,000. Non-working spouses is up to $10,000. And children coverage up to $20,000. And then groups of 100 to 249, working spouse GI limit is 30. Again, non-working spouse, the GI limit is still 10. Children are still 20. If you have groups that are larger than 249, so those 250 life groups, we obviously still we love mid-tier and large groups. Those we would look at individually. And provide a GI amount that is going to be different than the small group. So typically we can go up to 100,000, 130,000 on even larger groups. But I always caution people that our products are issued on a guaranteed issue basis, which means we know we get hit with a lot of adverse selection. And to stay in business, we've priced the adverse selection into the premium. So I really want to caution all of you on the call that if you have a group, and let's say you have some of the highly compensated employees or the owners come and say, okay, Tony, I want a $150,000 policy, or I want a $100,000 policy. I would caution you, because we will issue, we will get coverage in place, but I would advise you to guide that client to a fully underwritten policy, whether that be a fully underwritten life policy and or a fully underwritten long-term care policy. They will likely be able to find options that are going to be less expensive, because once they're fully underwritten, they're going to be accepted or declined. They might be accepted and rated up a little bit if they have a few minor things. but they're not dealing with that built-in pricing for the adverse selection. What I do not want to have happen, I don't want to have somebody enroll an employee at a high level and then have that employee go and sit down with a financial planner who's going to look at and offer life coverage and have them come out with a policy that is going to be, could be potentially 30% less. I don't want them to think that you have done them a disservice. So I always like to have a caution flag come out for you when you have somebody start to look in that higher death benefit, that 100, certainly that 100,000 above. You should see a caution flag and advise your clients it might be better for them to look for a fully underwritten plan.
Oh, very good. I appreciate that there, John. It looks like I don't have a whole lot for other questions here. John, I didn't know if I could beg you a favor if you've got that closing slide showing the health agenda and the phone number for everybody in case they would have any additional questions out there. The other thing, too, is I would definitely encourage everybody who joined us today to look into Allstate's got some really great group plans out there on all levels. So otherwise, if you have any other questions, of course, feel free to give us a call at the number. I know John's trying to put that up on the screen. I looked like you had it up there for a second, then all of a sudden it just went away there, John. I don't know if you.
I think I lost ability to put that up. Let's see here. Oh,
there you go.
Okay. Yep. Technology.
But no, I think for right now, I didn't see any other questions on that. We are recording today's session, of course, for those of you that would like a copy of this, from the replay or even from a training standpoint, let me know. Otherwise, just want to say thank you, everyone, for joining us today, and also special thanks to you, John, for co-piloting today's session. With that, I want to wish everybody a good, safe day, especially those that are in harm's way with the weather today. But thank you all for joining, and have a great day.
Thanks all. Thanks, Tony.